The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and this is our hour to make sure you got the best advice and best news and best information and all the changes that are in effect for your tax return to make sure that you don't overpay. And, of course, I'm joined in studio with Tiffany Fabian. Hey, Tiff.
Hey, happy Saturday.
It's cold out there.
Well, it feels like a heat wave to me. I know you've been not leaving your house very much, and I've been out and about. This is pretty warm.
Oh, you mean 20 is warm?
It's
yeah,
pretty warm.
But for those listening in Florida, in Naples, Florida, Marco Island, I heard it was 35 last night. So that's really cold for Florida.
Wow.
Right?
That's really cold.
And Christopher Fabian. Hey, Chris.
Hello, Esther.
Yeah, I talked to my sister-in-law last night. She said it was supposed to be 35 yesterday in Naples. So
Jeez.
that's really cool.
Speaking of
we
Florida.
have an office on Airport Pulling in Naples. If you want the best tax work done for the most reasonable fees, go to EG Tax, both in Buffalo here, Western New York, anywhere in the United States, Florida, Arizona, and you can ship them in, email them, text them, make an appointment. We want to help, right?
Yeah, and this radio broadcast also is on Florida at WGUF, and it's on Sundays
At 10 o'clock.
At 10 o'clock from 10 to 3. And so WGUF, please tune in, and you can email your questions on our website at egtax.com. And I know Esther will respond to them there.
Absolutely. Okay, our phone number here in studio is 8030930. 8030930, star 930 on a cell phone. You can text us at 716-8030930. We have all of our offices open, most of them 9 to 9, Monday through Friday, 9 to 5 on Saturday. We may extend our hours depending upon how busy we get towards our peak time. The IRS is open for business on the 27th. We are already getting acknowledgments, right, Chris, Tiff?
Yep.
So returns that we've been doing, we've already gotten acknowledgments. So 8030930, 8030930, star 930 on a cell phone. Text us at 716-8030930. Let's see, want to talk about the windfall fairness elimination. That we talked a little bit about it last week, about people that were working for the federal system or public employees that were not having Social Security withheld from their paychecks way back a number of years ago, 30, 20 years ago. And they just changed that in January. That was something Biden changed before he came out of office. And the people that are going to get it are going to be reinstated all the way back to January the 1st of 2024. So you can be expecting lump sum payments plus the increase to your Social Security. And a lot of people have said to me, why should they have gotten it if they didn't pay in? And that's an interesting comment.
Mm-hmm.
But again, so that was just changed. And it also affects widowers, widows, and beneficiaries who had government pension offsets because their spouses had passed away.
Yeah.
They're going to also get that money.
It's hard when you take into consideration that Social Security is so tight right now, and it's setting to go bankrupt in a little bit of time here. So that's what's so thought-provoking, but I'm sure we'll all make it work, And then the other thing I want to make sure we let people know about, if you're somebody that did not get the stimulus money way back in 2021, they're making that right as well. They're emptying out the coffers, right? The coffers that have nothing in. And you'd be entitled to that $1,400 per
taxpayer that didn't get that money. So if you're somebody that didn't file a 2021 return and you didn't get that stimulus money, you want to make sure you get your tax return done, even though there's no reason to file except to get the money. Right, Chris?
That's right. That's right. You know, you got to pay attention. You got to see what, you know, did you file? Did you get it? Because the third stimulus, people who were on Social Security, it was being directly deposited right into their Social Security, where they were having their Social Security directly deposited. So you really got to check your bank account
To find out.
if you got it, or log in,
Right,
create
so that's other free money. Then the last free money that dried up this year, it's not in New York law, but the IT 229 for people that have, again, maybe didn't file but are paying property taxes to New York State, and they might get a refund of $250 to $350 for 2021, 2022, and 2023. So if you didn't file, you want to make sure you file to get those refunds.
Yep, absolutely. I know I have a sign in the waiting room about the property credit. And so one of my clients today, he's like, hey, what about that property credit? Do we get that? And I said, well, that was really for last year and the year before and the year before. And I did give it to you. But people are paying attention, which is good.
Well, and I'm really glad. I had a guy that called this morning, and he said, you mentioned something about a 22S in New York State. And I said, okay, you 229. But, and I looked up his property taxes because you can do that online now. And he had like almost $4,000 in property taxes, so, and no income. So he should get that money.
Definitely.
So, okay. All right. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. I'm going to go to Joe in Kenmore. Hey, Joe, how can we help you, sir?
Hi, Esther. How are you?
I'm marvelous.
My wife and I purchased some bonds, and we paid accrued interest,
Okay.
and we received our 1099-R from Fidelity, and the accrued interest is not reported to the IRS. I use TurboTax when I file my taxes. How will I incorporate the accrued interest so that I don't have to pay as much taxes as I would if I don't report the accrued interest that I
right.
paid?
Wait, well, first you said...
Why would there be a 1099-R form here then?
That's what I was going to say.
Okay. A 1099-R form, Joe, means that it was a pension or IRA or annuity distribution.
It's not a 1099-R. It's a reporting. I'm not sure what the
1099 INT.
could be. Yes.
Yeah.
Okay. So I think we had somebody last week that asked about this. When you buy a bond, they basically send you the 1099 as if you had 12 months worth of interest. And you're saying you didn't get all that money, so you want to make that adjustment, correct?
Correct.
So on the bottom, underneath the Schedule B, that's where you would make that adjustment for the interest that you did not receive. And I can't tell you how they do it on TurboTax. I only know how they do it on EsterTax, so I can't really help you. But there should be an adjustment there for accrued interest on your Schedule B, which would reduce the taxable portion of, on the Schedule B.
Okay, sounds good.
But it should be on the 1099 INT. If it's not there, you can't do anything.
It is on the 1099, but it says this is not reported to the IRS.
Yeah. If you want to call, we're still not busy yet. So if you wanted to call me, I could do some research for you and find out exactly how you report it on that software. I don't know. I don't want to lead you incorrectly, but I'm at the office, 632-7886. Love to help you. Call. I'll do the research for you.
Can I ask one more question?
Yeah.
This is regarding a charitable distribution, qualified charitable distribution that
All right.
I made.
So you're doing you're over the age of 70 or older, right?
74.
And and you did it from your IRA.
Yes, direct.
Okay. Then your
So-
1099-R should have a code F, which would say that it was a qualified charitable, not a code F. It would be a qualified charitable deduction. So you're going to put the income out on the tax return on the 1040, but the taxable portion is going to show 0 and be QCD to let the IRS know that that you did the rollover.
Okay, I've received the 1099-R from Fidelity,
Okay.
and there is no code F there.
No. I'm sorry. I misspoke myself. It's not a code F. It's which
It will be a code 7.
Yeah.
And then what you do is you reduce the taxable amount by
the
your QCD, and you got to make sure you mark the 1040 on that line QCD.
Okay. So it's currently it's not showing up on the 1099-R.
It should have been on the
No,
1099-R.
it's up to you to report it.
But I mean, on the 1099-R in boxes 1 and 3, you have the total distribution, right?
Correct.
Okay, and then what you do when you enter it in the software, you're going to indicate that it was a qualified charitable deduction, and the software should eliminate the taxability.
Okay, I got you.
Okay?
Sounds good.
All right,
yes,
Joe.
appreciate it.
Thank you, sir. I'm Esther Gilius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. We're going to take a short break. We'll be back with your calls on the other side. Hey, to us, you are family. And family, we got all of our offices open to help you. But in the meantime, if you have tax questions, you can go to our website at egtax.com, ask the tax lady, and I will answer the questions as soon as I get those posed to me. So we're going to go back to the phones. We're going to talk to Dave. Hi, Dave. How can I help you?
Hey, good afternoon. I was just wondering, my child, first one in college, I got in the mail under my college student's name, basically what they paid in tuition. I actually paid their tuition for them since I didn't have a college like 529 plan and wasn't really eligible for financial aid. So just paid it out of pocket. I was just wondering, is that something I can write off with my taxes, or does my college student have to write it off on their taxes, or kind of who gets the credit and how does this work?
All right, good question, Dave. First of all, what year of school is your child in?
In college, basically just finished their freshman year.
Okay. So the child lives with you?
Yes.
Okay. So even though this 1098-T form comes in the child's name, which quite frankly, I don't understand why they do. Do you guys know why they do that?
Because they're
Over
the
the-
It
student.
just makes
Over the
me
age of
crazy
18.
because then what happens is the parent thinks they shouldn't claim it and the kid thinks they should. Now, you get this wonderful American Opportunity Tax Credit for the first 4 years of higher education, and this can be a very substantial credit on the federal. And on the state of New York, you also can get the Empire education credit, and that's another substantial credit. So you can get it, depending upon how much it is, there's 50% and an additional credit available up to $2,500 on the federal, and on the state of New York, it can be a credit or an itemized deduction, whichever works out better. But you should claim it, and your child should not. And in 99.9% of the cases, that's how it should be. You do have taxable income, correct?
I do, correct.
Okay, because only 1,000 of it is refundable, but the balance of it is a tax credit to offset other taxes. So,
And
absolutely, AOTC.
And all of his college wasn't paid for by scholarships, right? There was some loans.
Correct. Yeah, basically, I had some loans, but the loan only covered so much, and so just so you know. It's so
All right.
tough.
Let me also say this. Let me also say this to you, Dave, and all the parents listening. It had to be for higher education. It had to be for the actual learning, books, supplies, equipment. Okay, it can't be for housing. Okay, that's number one.
Gotcha.
Number two, you could, if the parents even didn't pay for anything and they borrowed all the money, and the kid is the one that's on the note, it's still the credit for the parent. So that's what a lot of parents don't know. They think that unless they paid it themselves, that's the only way you take it as a deduction credit, and that's not the case. The kid could have borrowed the money, you get the credit.
Okay, no, that's good to know. And just one other question about with the college. So as their education continues, they're probably going to transfer to another college, which is going to be more expensive, and there's going to probably be some housing there with that. Just wondering, with the increase in student loan amount that is going to be needed and maybe assistance that I can do, is there a best method forward to go about doing that? Because on paper, looking at housing and the cost, within 2 years, my college student could easily rack up, close to $45,000. So I'm just trying to figure out, is it better to do like a child and parent type college loan?
Well, first of all, I would do a 529. You can put money into a 529 plan, then take it out to help pay for like the housing, which is not going to be deductible on the American Opportunity Tax Credit, and then you get a deduction on New York State. So that might be something you'd want to do. Who I would suggest you talk to is at the Financial Guys. They have a
college
planner.
Right. But I can tell you the student loans, they only give the student themselves only a certain amount a year. The rest has to be parent plus loans. So,
but I would suggest, who is it at the Financial Guys, Chris?
It used to be
we don't know.
Anyway, I would call. But
there.
anyway, I'd call the Financial Guys. Their phone number, what is it?
633-1515.
Yeah, and ask for their college planner because they can give you all the lowdowns on who's the best and where's the best.
Another thought: if you wanted to get a rental property, you could get a rental property, and your child could rent from you. Because did you say he's moving out of state eventually, or?
So still going to be in state, but we were just worried because we have another one going into college as well, and I didn't know if with the student parent plus loans, do they look at like a normal loan, income to debt ratio? Like, will we ever get
No. They're very generous with the loans. But again, it is well worth the trip down to. I know you're in Lockport, down to the Financial Guys because they have a college planner, and that's what you really need.
Okay. That sounds great.
Hey, thanks for calling. All right, we're going to go to Mike. Hi, Mike.
How you doing, Esther?
Good. Oh, Mike, you're my friend from West Seneca.
Right. Question, and I believe because it's taxes, I think I know what the answer is going to be. On that rebate for property taxes paid, I own my own house, and I also own one from my grandparents' estate. That immediate family, children and stuff like that live there. I don't get rent or anything, and I pay all the freight. I know what landlords feel like now. Is that only for your own, or can you get more because it's another property and it's not a rental?
All right. Because it's a rental that is being handled personally, it's not going to be deductible except for property taxes that you might pay on the property. But pretty much you just being a good guy, that's going to be the only deduction that you're going to be able to take.
Yeah, but I mean, I pay the taxes, I pay the insurance and everything.
Right, but the only thing you can take is the only thing you can take when it's a personal property, and so property not rented to make money. If this was rental property and you had a profit motivation, then all the expenses would be deductible. But when you don't charge rent, then it flips over to a personal asset, and so the only thing that's going to be deductible is the property taxes.
Okay, so there's no extra rebate on an extra property.
No, you just get a star in your crown in heaven. That's all.
That's what I thought you'd say.
All right.
But I mean, being taxes.
I know.
Right, thank you very much.
Thank you, Mike. Thanks for calling.
Chris was kind enough to go to Next Financial's website. The college planner is Michael Shaver.
Okay, that's good. That's good to know.
Yeah.
All right, we have some texts right here.
We do. The first one says, can I still get the enhanced star, Elder Star, for 2025 if I file the paperwork, and when must the paperwork be submitted by?
March 1st is that deadline for the enhanced star.
Right. So you make sure you do that. What else we got there?
So they still have time. Hi, tax lady and crew. Does it make sense for a retired guy collecting Social Security benefits and IRA withdrawals with a working younger spouse to contribute a standard IRA from wages of a part-time reduced taxable income? A little wordy, I know. Thanks. Go Bills.
Go Bills for sure. Really, the standard deduction is very high, and so what you need to say is when you take all of your income, including your spouse's income and your pension distributions, and you add it all together, if there's still a tax liability, then you'd want to take a look at using an IRA to reduce that liability. So without knowing all the numbers, I can't say, but basically, looking at a $30,000 standard deduction plus the additional standard deduction of $1,500 because you're over 60. I'm assuming you're over 65. Means that at about $33,000 in write-offs, you might not even need to do the IRA. But if your spouse is making $50,000-$60,000 and you still have some taxable income hanging out there, I would do the IRA.
Yep.
It would be absolutely great because then you might get the pension savers credit too.
Right, and the nice thing is you have to April 15th
to do that contribution.
Correct.
All right. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. We're going to take a short break for the news, and we're going to be back on the other side with your comments and questions. Hey, to us, you are family. I'm Esther Golias, the tax lady, with Tiffany Fabian, Christopher Fabian. We're here to answer your tax questions. 8030930, 8030930, star 930 on a cell phone. Text us at 716-8030930. And for those of you that are in Florida listening, you can just go to our website at egtax.com. Ask the tax lady, ask your question that way, and we'll answer it right away.
Yes. Yeah. Do you want me to read that or?
What do you got?
Dear Esther, do you have to prepare the paperwork each year for Enhanced Star or just one time? Thank you very much. You have to prepare it every year because I need to know about your income.
Well, it goes off of your tax return now. So if you don't file a New York return, you got to go to your town, and hopefully they have the forms where you can do it. But yeah, it should be annually. But if you file a tax return, they go right off your tax return to see your income that way.
And so as somebody would be sitting home thinking, well, I don't know why I have to file a tax return. Well, because it makes it easier. If you file your return, even though it's zeros, at least you won't have to go down to City Hall. And again, there's all these little enhancements, like the $1,400 stimulus. You had to file a tax return for that. The 229, if you are paying property taxes on New York State, you had to file a tax return for that. And by the way, when they make that offset for the windfall fairness elimination refund of Social Security, that's an automatic payment for you.
Right. And then also, the Enhanced Star, because they do look at your tax return, it's only for if you do, and I'm going to use the term, and I don't mean for Social Security, get a windfall, and you do get extra income for 1 year, you only lose the Enhanced Star for that year.
Right, and that goes back the next year when your income goes down.
Right. So,
and same thing might happen if your IRMA is too high, right?
Correct.
And then if you have high income 1 year, and the next year they would adjust the Social Security portion of your Social Security taxes, the Medicare portion that they're withholding.
And for those listening in Florida, the Enhanced Star is similar to your
homestead exemption
that you get in Florida. So you're not going, what? I can get a star?
Yeah, right. Sometimes when you pay the taxes here, you need a star, right?
Yeah.
All right, let's talk about, again, 8030930, 8030930, star 930 on a cell phone. Text us at 716-8030930. I hear these commercials all the time that says, why don't you talk to us because we can fix it so that when you take money out of your IRA, when you have to do your required minimum distribution, you won't have to pay the taxes. Okay, that may be what somebody's saying to you, but what they don't say is, when is it taxable, Chris?
Now.
Right. So many times people will call me and say, I think I'm going to do this distribution to my Roth. Okay, I'm going to roll over my money from my traditional IRA to a Roth. But here's how it really works. If you rolled over $400,000 from a traditional IRA to a Roth, you are going to pay taxes on the federal and the state in the year of the rollover. And in this situation, because I actually did the tax return, they would pay $120,000 in federal taxes, federal and state taxes. Plus, if they strictly did a Roth their whole time that they're employed, they would miss $44,000 in tax write-offs as they earn the money. So they'd really be out $164,000. So yeah, that's true. They wouldn't have to pay anything when they retire, when they have to do your RMDs.
Right.
But the truth is, you're paying it all up right front right now. Plus, you lost $120,000 worth of assets that are now gone if you have to take that money out of your IRA.
Also, if they're married, you brought this up just a minute ago, they're IRMA.
Right.
They would pay an extra, probably almost $1,000 a month.
Another $12,000.
Right.
So now it's not 164, now it's 176. Right. So you really have to understand that you need to put a pencil to the equation. And then when you do start to withdraw, and nobody wants you to pay taxes, but remember, you had $164,000 plus in savings over the years by not rolling it over. When you start to take it out, the standard deduction is getting higher and higher and higher. And many times when your investment advisor is doing these computations, they don't reduce it by your standard deduction, which is over $33,000 right now if you're filing a joint return. So that would be tax-free income. So it's not as simple as how they pose it. Plus, the other thing is you're relying on the fact that the federal government is going to have the same tax code when you retire. And I was thinking about that. Do you have any idea what they're proposing right now? With Trump's been in office for 5 days.
Reduce
It's been
taxes.
like a whirlwind.
Reduce taxes.
Pardon me?
He wants to reduce taxes.
He wants to eliminate Social Security taxability. He wants to eliminate tax on tips. He wants to limit tax on overtime.
Right.
And so I'm thinking and who knows what they're going to do in the future. And some of the things that have changed over the years since I've been doing taxes, one of the things was Social Security. Remember when Social Security wasn't taxable at all, but then they made it taxable, right?
Yeah.
The energy credit that's in the 2024 tax return, if you're listening between the lines with Trump, he's saying we're going to get rid of that. So if you didn't jump on the bandwagon last year and this year, 2023 and 2024, you're not going to get any of those large credits for energy.
I was just doing a tax return a few days ago for a guy who works at a place that does cars, a very big company around here. And he said, I just switched it all to a Roth, my 401k. And I was like, no. He goes, but I hear everybody saying the Roth, and it grows tax-free and it grows tax-free. And I said, no, maybe you should diversify, put half in the Roth and half in the traditional. And so I explained to him, defer.
Did he do the rollover?
No, he didn't. But
So
he
this
was
is
his contribution.
is a fresh setting up.
Well, he already has been contributing for a long time. He adjusted and fine-tuned it, he thought. And so going forward, all of his contributions.
okay.
He
were-
changed it from a traditional
Okay,
to a
so
Roth.
because
the
he
new
had
money
heard
is
the
Roth.
hubbub about.
Well, and that's the other thing people have to understand. If you're the only one, if you have a government pension, if you're lucky enough to have a government pension, state of New York, police officer, firefighter,
what I told
and you
him.
have like $70,000-$80,000 coming in your pension and your Social Security. Maybe in that case, you'd want to look at fresh money into a Roth. But if you're like the rest of the us schlubs out here, where you have to contribute to your own pension, you might only end up with $500,000 that's got to last you for 30 years. So you're taking out $10,000 a year. Guess what? It won't be taxable when you take it out because it's so small.
That's right.
But they don't talk about that because they don't know taxes.
Correct.
Right?
Yeah.
All right, I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. Another thing that they've changed is the capital gains. We remember when capital gains was not taxed at the preferential rate. I guess what the point I want to make is you really can't trust those people in Washington to not change the tax law. So many times and so when you're paying all these taxes up front because you think in 20 years it's not going to be taxable, well, I mean, you really don't know. It depends on who the regime is, who's running the regime.
Yeah.
That's right. I mean, and right now, Roths are tax-free. They could change the law.
Absolutely, they could. If they're desperate, and I think that they think that they're desperate. But then again, now, when you look at some of the things that Trump is proposing, he's really proposing an external revenue service.
Right.
To go after all of the tariffs. So I'm thinking that he's thinking of utilizing that money to help pay for the budget deficit.
Yeah.
But here's the thing: as soon as we know, and I know he's going to hit the ground running because that's what he promised on these tax changes.
Yeah, most definitely. I mean, you could see in the last few days he's really done that. Yesterday he was traveling to North Carolina and California. I mean, he is getting things done, and he really it seems like he really cares about his word.
Right. Okay. Now, some of the things I wanted to talk about here, and again, 8030930, 8030930, star 930 on a cell phone, is that there is a marriage penalty. And people aren't aware of it. But the other day I had this sweet little girl that came in the office, and she's, I said, what's new? And she said, well, I got married. Well, that sweet little girl last year was a single mom, and she made $15,000. And so what did she get? An earned income credit,
yeah,
right?
Right. Not
But
much this year.
as soon as she got married, they have to do a married filing joint return or a married filing separate. You don't get an earned income credit if you're married filing separate. So she's going to lose refunds of about $10,000 because she got married.
Yeah, which is so discouraging, but it's the facts. And so you really want to plan for it.
And the other thing is, I think a lot of people aren't aware, but if you are somebody that has a brokerage account, and the brokerage account, and you're married, and the brokerage account is in one or the other name, and there is a loss, how much of that loss can the spouse who inherits that brokerage account take on the tax return if they're carrying forward the loss?
$1,500, half. I mean,
no.
If it was the other spouses and that person died, there would
the
be.
other
That's
spouses.
right.
Okay,
You're not
sorry.
allowed to take the loss. So let's say the one spouse had the brokerage account in his name and was carrying forward a $50,000 loss, and she inherits it. I'm saying she. That loss would not be deductible on her tax return because it was his money. Mm-hmm. Even though she gets a stepped-up basis, though. So. On his brokerage account. All right. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. Text us at 716-8030930. And we're going to go to Sue in Depew. Hi, Sue. Oops, wrong way. Hang on. Hi, Sue.
Hello. Hi, how are you?
Good.
Happy Saturday.
My husband and I are separated, not legally. He hasn't lived with me for a couple years. Last year we filed joint. I'm just wondering if we should still file joint or do individual. I mean, I expect, we'll be divorced eventually.
Do you have children?
No children.
All right. So there's this little stipulation in the law that says even though you're legally married and not living together, but you don't have a divorce, but you have children that live with you, then the person who is the custodial parent could file head of the household, okay, if she contributed over 50% of their total support. In your situation, you probably should take a look at filing separately, the two of you, because you may make out better if married filing separate if you both work. Do you both work?
I work, he does not. No, actually, I'm retired, but he does not work.
Okay, well, then in that situation, you're actually kind of shooting yourself in the foot if you don't file jointly, because he has no income, so to speak, and so the larger standard deduction would be something in your benefit. So I think filing a joint return is the best way to go. What you'd want to do is ask your accountant, though, to say how much are you saving because you're filing a joint return so that you can more equitably get the refund you're entitled to.
Okay. Well, you guys do my taxes.
Oh, well, then we'll just ask us and we'll tell you.
Okay. Sounds good.
All right. Thanks, Sue.
But in her
Thank you.
situation,
Bye-bye.
it sounds like joint would be the best answer, just from what
Yeah,
we hear.
because of the standard deduction.
Yeah,
Absolutely.
Yeah, it sounds
Okay.
like joint would be best. But it's good to ask that question. And now, if she had a child, and
Then it would be really remarkable for her to file separate. She'd be head of the household,
right,
right?
and so,
if she had wages, right?
yep, it would be much better probably for her to file.
All right, I'm Esther
separate.
Villius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. Text us, 716-8030930. We're going to take a short break, and we'll be back on the other side. Well, boy, I'll tell you, everybody I talked to today, I said to them, "What are you doing for watching the game?" "Oh, I don't know if I can watch the game. I get such an upset stomach." It made me feel good to know that I'm not the only person who gets really upset when they're playing. I think it's more common than you know.
The people I were with today, they're like, sometimes I'll go to the grocery store. Really, they said it's not so busy.
Yeah, I turn on Lifetime TV. That's how boring it. I'm so afraid. And in the back of my head, I'm thinking, oh, an hour went by. I should check the scores. No, don't check.
And then people text you things, and so you're wondering. I haven't had any, or I've had.
When nobody texts me, I think, oh, it must be so bad they're not texting me. Anyway, it's kind of sick. Okay, back to taxes here. Things you should really watch out for. Debt cancellation. I had just had a client that came in today, and she had a letter from the Internal Revenue Service because she had about $10,000 in canceled debt. Canceled debt is taxable, but not always, right?
Right. If you're insolvent, you can do a 982 and not pay taxes on it. Insolvent means your assets, the things that you own, are less than all of your outstanding debts and liabilities.
And so I said to her, "Do you own a home?" "No." "Do you have a pension plan?" "No." "Do you own a car?" "No." "Well, do you have any assets in your name?" She said, "No, I have nothing." "How much is your credit card debt?" She said, $50,000. Ding, ding, ding. You win the ball game. So I did a 982 and got her out of the $10,000.
Yay.
Yeah. But
Now-
here's the thing. Canceled debt is income, so be very careful about that. And make sure that you're paying yourself the correct wages. Don't include pensions. Make sure you and only taxing yourself. I don't, whatever. Oh, I know. I wrote it down here. So when you're entering your W-2 onto software, if you're doing it yourself, make sure that you don't include your tax-deductible pension into the income. A lot of times I'll have people that'll say, "I don't understand why box 1 is less than box 3 and box 5. And that's because they don't tax you on your qualified pension plan. So don't include it.
Yeah, and what you're talking about those boxes. Today I was doing a tax return, and the health care worker bonus is still out there. So I was surprised when I saw it.
And that you have to take that
And
as
you
a
have to
deduction on
take
New
that
York State.
as an adjustment on New York State. So if you are a healthcare worker and you got a bonus because during COVID you were really working really, really hard, which you were, there's a bonus that your employer paid you, and you get to subtract it off the state. So don't forget to do that.
And that was over the last couple of years.
Yeah.
So if you got that a couple of years ago and you haven't been putting it on your New York State return as an adjustment, you've overpaid.
Was that what
and we
you were
can
gonna
get you
say?
your money back.
No,
What Chris was
I
going
was going to say, I had a client the other day came in. She wanted me to look at her 22 and 23 return and do her 24. And she, going back to the first caller of the day, used that other software. And she had New Jersey and New York income because where her company's situated. And the other software doubled her income on the New Jersey return.
Oh.
So she was paying a ton of extra tax because of this. And she said,
did she do the 112 R?
Yeah, but she did it incorrect. But she said, I called them. I got their live expert on the phone, and they said, you did it right. Everything's correct. And it wasn't. She goes, I wonder if I could get some money back.
And
from
so
them.
you amended the return.
I
right?
amended, and I got her a lot
Oh,
of
you
money.
mean for the paying for the software?
Yeah.
Okay, and the other thing you should look out for on my list here is gambling winnings, because gambling winnings, especially to a senior who's collecting Social Security, the income goes in on page 1, but your deduction, which would be equal to your gambling winnings if you actually lost that much, is an itemized deduction. But the income then is sitting out there, and it could make your Social Security up to 85% taxable. So you're not allowed to net the winnings and the losers on page 1. You have to do it in 2 separate sections.
Also,
Irma.
with gambling, when do you get that W-2G?
When you're at the casino and you win.
Right. They don't mail one at the end of the year. You have to save them throughout the year. And if you lose them and you forget about it, guess what? The IRS isn't, and they'll mail you a letter a year and a half later.
Right, and that'll and then the other thing Tiffany was saying, it could ruin the Irma too, right?
Yep, your Medicare.
Inheritances. People have to know how to handle inheritances. Cash that you get is just not taxable as an inheritance. However, if you inherit an asset, if you inherit if you inherit pensions, IRAs, annuities, stocks and bonds, though that you might get a stepped-up basis on some of it because it's a capital asset. But when you're inheriting IRAs and pensions, those could be fully taxable. So they are all handled differently.
Yeah, there's a caller, but I was going to say I was with the client today, and regrettably her brother passed away, and so she inherited his IRA, and she has to spread that over 10 years.
On an IRA.
Yep,
right.
Yep.
Okay, I'm going to go to Mike. Hi, Mike. How can we help you?
Well, I got an email from my stockbroker.
Okay.
I own some stock in a company, and this is called a rights exercise offer. I don't know. Apparently, they want to buy my stock. I don't understand. And what are the tax implications if I sell or don't sell?
If you sell, it's going to be a capital gain or loss depending upon what you paid for it plus any reinvested dividends. But what you need to do is talk to your stockbroker and find out what the offer is.
Okay. Well, I deal with Charles Schwab online, so I don't really have a stockbroker to talk to.
Okay, but they do have a customer service line, right?
Oh, do they? Okay, so I should call them.
I would.
And so it's just a standard, like I would have a gain or a loss then, depending on.
Absolutely.
Oh, good.
I hope it's a gain.
Yeah, no, it's a loss, unfortunately.
But then you get to take the loss against your other gainers and your capital, your dividends, and if it's over and above that, plus 3,000. So at least it'll help the wounds a little bit.
Oh, so the maximum loss I can take is 3,000?
Well, no, you're going to offset. Do you have other gainers from the sale of stock?
No, I didn't sell any stock last year.
Do you have capital gains distributions, dividends?
No.
Okay, then
dividends?
you're
Dividends?
Yeah.
You have dividends?
You have dividends?
Yeah.
So let's say your loss is 10,000 from the stock, and you have dividends of 4. You're going to use the 4,000 of that loss to offset your $4,000 in dividends, and you get to take an additional 3,000 and carry it forward.
Okay, so if I earned like 25,000 in dividends, and I take a loss on this stock of about 20,000, then I.
Okay, no, I misspoke myself. No, all you're going to do is you can take the 3 and carry forward the rest of the other 7.
Yeah, the capital gain. If you had mutual funds that had capital gains, that would offset that.
Right. If it was a capital gains distribution, right.
Do you have an office in Orchard Park?
We do.
Whereabouts? Oh, you're on Orchard Park Road.
Right.
Yeah.
I've been by. Okay, I'll stop in there and I'll go over it with somebody. Then I'll have to. Have
Yeah,
you
the
guys
person
come
who's
in.
in that office what's his name at the office?
Tom Kelly.
Tom Kelly is there, and he's a great guy. So Tom can help you.
All righty.
Okay, Mike.
Thank you very much.
Thanks for calling.
Okay.
Bye-bye. Okay, so let's see. Any last minute things you guys want to talk about? Oh, the other thing is on your stock brokerage forms, when you're getting your brokerage statement, they might have something called a 199A deduction.
I was thinking about
that
that.
saves you money too. So you want to take the 199A deduction.
Right. Yeah, absolutely. And then, as you had mentioned last week, Esther, maybe if you're a young person and you pay on your student loans, your employer might be kind enough to treat that as a contribution into your 401k up to the amount that you pay into your student loans. And so that's a new little caveat in the law.
Right. That's brand new.
Yeah.
So kids that are parents or they paid into their student loan interest, that's considered an elective deferral, which can be used by the employer to put more money into the employee's.
Right. That's anybody who pays a student loan. So it could be a 40-year-old.
Right.
Right.
I was just
Absolutely.
thinking a 40-year-old might max out his pension. So I was thinking.
Well, but there's 40-year-olds that don't put anything in.
Right.
I had a 60-year-old that was not putting anything in.
Right. Me too.
Okay, well, I'm Esther Gilius, the tax lady from EG Tax. You can go to our website at egtax.com. Ask the tax lady. Be happy to answer any of your tax questions. All of our offices are open 9 to 9, Monday through Friday, 9 to 5 on Saturday. We have a couple smaller offices that have abbreviated office hours. You can take a look at our website. It'll fill you all in. But until next week, be warm, be blessed,
Go Bills.
and
Believe.
go Bills. And believe.
And
Right.
today's Happy
Thanks for
National
listening.
Florida Day, somebody said.
And today's Happy Florida Day. Hello. All right. Thanks for listening.